Let's talk some big picture as the week's going to get interesting as we get to the halfway point, a little closer to inflation. Kevin Gordon joins us, senior investment strategist at Charles Schwab, and Collin Martin, director and fixed income strategist at the Schwab Center for Financial Research. Afternoon, guys. Good to see you. Kevin Gordon, get us started here. What piques your interest in the second week of the new year?
I think probably the CPI data, maybe some of the currents, some of the subsurface data, specifically within core goods. I know that the expectation is probably still that you're going to see deflation, but I think one of the themes this year, as you kind of start to go fully out of that, normalization of the bullwhip that you had associated with the pandemic and the lockdown phase, it's going to be really interesting, I think, to see what the pattern is for core goods inflation this year in the face of what is still, sort of this decelerating trend in services disinflation. So again, not the expectation that you're going to go back into inflation territory, to the upside for core goods itself, but I think that's going to be probably not the key needle mover for the Fed and policy there, but I think a key sort of aspect of how we analyze inflation for the rest of the year.
Potentially interesting print this week, Collin. I mean, we're hovering at that 3% still. It's not going to be like a super disinflationary month over month, right?
No, it doesn't look like it. We're looking at that core reading on a month over month basis because we like looking at that month over month and then annualizing it either on a 3-month or 6-month basis because that gives you a better idea of what inflation is in the here and now. And on a month over month basis, it's expected to come in at 0.3%, which would be flat from the November reading. If we see a slowdown in the disinflationary trend, then that would likely just push back the potential for rate cuts. I don't think it would necessarily spur more rate hikes. It seems like that's behind us. We think we're at the peak. We would really need to see a reacceleration to get that. But if we see a cooling in inflation, that just means that they don't need to cut to keep rates restricted, because that's a key point that we've been talking about. The more inflation falls, the more that real rates get restrictive. That can result in those rate cuts that everyone's waiting for right now. But if that process slows a little bit, maybe that pushes back that initial time frame for when that first rate cut arrives.
Stocks still sensitive to changes in that timing for cuts, Kevin, or have we sort of started to move on a little bit for equities, whether it's 6, whether it's 5, whether it's 3?
Yeah, I mean, it's hard to make the case. I mean, that's such a fast-moving narrative, I think, with the prospect for cuts itself. I mean, you could argue that was the case last year where the market had to readjust multiple times, but I think there were other reasons that we hit, pockets of weakness. But yeah, if you want to tie it to the move in yields and the move in the bond market and the fact that you still have this pretty extreme negative correlation between bond yields and stock prices, then yeah, you could probably say that's the case. But I don't think that, the repricing or the pricing out of cuts and bringing back and dialing back that expectation necessarily means, weakness for the stock market. I think that, if you have an environment where growth holds up, you get data that sort of encapsulates something of a soft landing, and the Fed doesn't have to cut aggressively. That means that the economy, the real economy, can handle higher real interest rates and, doesn't have to suffer necessarily. I don't think that's a bad backdrop for the equity market. I think that's, probably the best environment you could get if the alternative was the Fed has to cut aggressively because the economic data are coming in, much more weaker than anybody expected. So I'd much rather take the former scenario. And I think that, although it would probably be some sort of longer digestion phase because you're moving out of what we got used to in terms of low interest rates, for the decade or so that preceded the pandemic, I think that's still a better case scenario.
Okay. Very good point that we got to keep in mind. Not all cuts are the same, right? It kind of depends why they're happening. And we don't have that information just yet. So we'll have to see how the market responds as it becomes clearer. What do we know about the Fed commentary, Collin? We've got a pretty busy week. We've had a few words here and there from a few speakers. But what do we know about, like, who's the hawk, who's the risk, who has the willingness to shake it up? And is anybody doing that in your mind?
It doesn't look like anybody's going to be doing that, Oliver. And it's funny because we talked about this last week with Neil Kashkari no longer a voting member this year. Last week we were talking about, well, who is the hawk now? And kind of the hawk for 2024 purposes would be Michelle Bowman. So she's a governor. She gets a constant vote. She doesn't rotate out as a member of the Fed Board of Governors. But just yesterday we got comments from her where she actually acknowledged that her views have evolved. That's the term she used. Now, it doesn't mean she's anticipating rate cuts anytime soon, but she sort of gave a nod that we're likely at the peak right now. Of course, she hedged it a little bit, where if inflation were to reaccelerate, maybe more rate hikes would be necessary. But overall, the outlook she provided was relatively consistent with the outlook of most other Fed officials, that we're currently at the peak and that the next move is likely to be a cut.
Okay. I like that. Very helpful as we're trying to figure out, where the hawks are hiding, if there are any. Seems like there's, even if there might be one or two compared to each other, none of them are like super hawkish on, from kind of a nominal standpoint, if you will. Kevin, how about general market momentum, breadth? I know you like the technicals and the under the hood stuff, so give me a take on that before we close it out.
Yeah, it's generally looked stronger, whether you're comparing to, where we were a few months ago, whether you're comparing to, where we were a couple of years ago. I know there's a lot of comparisons being drawn to, kind of a weaker start to 2024 and that being a little similar to 2022. But, I would just encourage anybody who has that view to look at the breadth setup going into 22 is much weaker than it has been going into this year. I mean, even if you go back to the very beginning of this year, you had sort of a breadth thrust signal in terms of the percentage of S&P 500 members that were moving above their 50-day moving average, moving above their 200-day moving average. You hit 80%. That's sort of a threshold that we've been waiting to clear for literally a year. So I think that the setup, even though you have sentiment metrics that have gotten a bit frothier, that always happens when you're in uptrend. So I think that the backdrop today is a lot better, and I would focus on advancers relative to decliners, the fact that they've been stronger and that ratio has been a lot stronger when you've been moving higher, and even on days when the market's weaker, you haven't seen this complete washout where investors are just selling everything and throwing everything away. So that sort of churn over time and still that stealth rotation that you have under the surface that we've been noting in leadership, I think is a positive development if it continues to happen and broaden out.
All right. Great stuff, guys. Nice teamwork tackling the market for us this afternoon. Appreciate a good macro conversation as we spent a lot of time talking stock specifics. Very helpful to us today. Collin and Kevin.